But really, what we see, in my opinion, is we will begin to see investors or big players begin to lose confidence in the paper gold markets. Maybe we're already seeing that, where there's three or four or five or however many contracts issued per bar. And I think what people are realizing is that physical possession is very important right now, and this could very quickly push prices considerably higher as there is a scramble for physical, and it could put some of these banks, these clearing banks or bullion banks, to the brink of collapse or default. This is an existential threat.
Gold prices reached a historic milestone on Thursday, surging above $2,950 per ounce amid growing safe haven demand and global economic uncertainties. This price movement has intensified discussions about potential gold revaluation, particularly regarding the U.S. government's gold holdings. AndySchectman, CEO of Miles Franklin Precious Metals and a respected authority in the precious metals sector, has brought attention to the significant disparity between current market prices and the official valuation of government-held gold. Schectman points out that adjusting this valuation to reflect current market prices at around $2,900 would dramatically increase the account's value from $11 billion to approximately $800 billion. The concept of marking to market these gold reserves has gained traction among financial experts. Notable analyst James Rickards, cited by Schectman, suggests even more dramatic possibilities. According to Rickards' analysis, a revaluation of gold to $24,000 per ounce could inject $6 trillion into the Treasury general account, with each $4,000 increase in gold price contributing an additional $1 trillion to the Treasury's balance sheet. The implications of such a revaluation would extend far beyond government balance sheets. Financial experts suggest that if the U.S. government were to formally increase the value of its gold reserves, market prices for precious metals could surge by 50% or more. This potential shift has captured the attention of global investors, particularly as concerns about inflation persist and central banks worldwide accumulate gold reserves. Before we begin, subscribe to our channel and click the bell icon to stay updated with our latest content, market insights, and expert analysis on precious metals, economic trends, and global financial developments.
If you look at gold, everyone's talking about that, held in the gold revaluation account and valued at $42.22 an ounce. They could market to market, and it goes from like 11 billion to 800 billion. Market to market at 2,900. The gold holdings, they could move it up to 24,000, like James Rickards says, and add $6 trillion free and clear to the Treasury general account, as every $4,000 increase in the price of gold adds $1 trillion free and clear to the TGA. It's taking assets and giving them value, putting them on the balance sheet and giving them value and finding ways to increase that value. So it was an interesting statement, especially in light with Judy Shelton saying on July 4th next year they will issue the 50-year treasuries backed by gold, the 250th year anniversary, and then Scott Bessent making that comment, who's, by the way, his largest personal holding is gold. So that's why me and a lot of others are saying, is it too coincidental that we're net importers of gold? We're seeing the largest delivery in the history of the COMEX happen on the February contract of nearly 6 million ounces, and JP Morgan delivering $4 billion in gold to the Treasury. And they say, Blythe Masters has said, and she used to run their desk, we don't buy it for the bank, we buy it for customers. So what customer has $4 billion in gold, $4 billion to buy gold? Is it the Treasury, the Fed? Who knows? But anyways, it just simply means turning these assets that are just sitting there, turning them into revenue or income or money. But really what we see, in my opinion, is we will begin to see investors or big players begin to lose confidence in the paper gold markets. Maybe we're already seeing that, where there's three or four or five or however many contracts issued per bar. And I think what people are realizing is that physical possession is very important right now, and this could very quickly push prices considerably higher as there is a scramble for physical, and it could put some of these banks, these clearing banks or bullion banks, to the brink of collapse or default. This is an existential threat to these banks, which in my mind would trigger a cascading event. Obviously, it would jeopardize the LBMA's ability to settle contracts, but at T plus 8 weeks right now, you could argue it already is a default. And this is the largest over-the-counter market in the world for gold. Most of the transactions there are settled in paper rather than physical, but now we're beginning to see a cascade of delivery demands, which very quickly can expose the whole system. And or create a run on the vaults, just like a run on the banks, and realizing that there's not enough physical gold there to cover. This has never happened before. We've talked about it on your show for 4 years, but never like this. It was that little by little thing. So, is it something that is related to the Basel III Accord, which United States banks, I guess, are going to embrace in July, maybe, which allows them to, call it a tier one asset, at least in terms of their ability to borrow off it against an asset to borrow against with the Fed. I don't know. I don't think it's just that. I think it's something deeper. But whatever it is, it's beginning to really shake things up across the globe as it pertains to the physical gold market and the physical silver market. It hasn't spilled into our reality yet, but it will.
The precious metals market has undergone a remarkable transformation over the past 25 years, as illustrated by the dramatic price evolution of American gold eagles. AndySchectman provides a compelling perspective on this change, emphasizing the substantial capital increase required to operate effectively in the precious metals market. He recalls when a tube of gold eagles cost around $500, with gold priced at $252 per ounce. Today, that same tube costs over $60,000, reflecting the substantial increase in gold's value. In August 1999, gold prices hit a low of $252 per ounce, with a tube of 51-ounce American gold eagles trading for about $16,500, based on a spot price of around $290 per ounce. Strong stock markets, low inflation, and reduced demand influenced gold's low price. However, this marked a turning point as from 2000 to 2011, rising economic instability and financial crises boosted gold's value as a safe haven asset, leading to a significant price surge. Fast forward to 2025, and the market landscape has transformed dramatically. A tube of 21-ounce American gold eagles now commands approximately $60,000, reflecting not only the substantial appreciation in gold's value, but also the increased sophistication and capital requirements of the modern precious metals market. The Schectman notes that this price evolution has fundamentally changed how dealers approach inventory management and buyback operations. Let's get back to the video.
I don't know. Maybe they're scurrying. It would be a very big problem. Gold would go parabolic. But that's not all the gold they hold, too. I mean, they have to audit Fort Knox. They have to audit the New York Fed, maybe the West Point Mint. I don't know, because it's not all of the gold we hold. It's a lot of it, but not all of it. But it's a good place to start, and it's long overdue. Let's hope it's there. Most people in this industry for a long time has thought it wasn't there. But if he did a live stream and showed everyone and it really wasn't there, it would be very big problems. Gold would go to the moon immediately. If institutions began to lose trust, and you could argue that some may be beginning to lose trust right now in the Bank of England and the LBMA, and what could happen in a market that is dominated by paper settlement, and these entities at the end, the person who went long. So if a bank like Standard Chartered or Deutsche Bank goes short and keeps going short with nothing behind it, knowing that the probability, if they keep doing this, that the long will just capitulate, they say, no, we'll stand for delivery, but I don't have the gold, they say. Well, that's a problem. And the systemic nature of it all, where all these banks are connected. This is why evidently UBS had to bail out Credit Suisse, or would have brought down the entire matrix. So these banks are not just bullion banks. They're highly connected systemically through all different forms of derivatives through the whole ecosystem. Is it the beginning of some sort of an event, a blow up? I doubt it, but who knows? The whole system is, I think, frail to say the least. But that's how serious it truly is. You see a failure to deliver by one of these big banks, and it's a daisy chain, certainly to the metals market. But what does it mean to the other areas that these banks are invested in, to the bank itself, to the tax credit default swaps, rather, to the insurance industry that backs that up? The whole thing has been layered and layered and layered through derivatives so deep, so intertwined, that it's something that we probably don't want to find out. You have to have enough money to do the business and to keep product revolving in and out, and to buy stuff back, and to keep the game going. It's becoming a very expensive game. I remember, I've been doing this for a long time, where a tube of gold eagles was $500. at 252 ounce gold is just over $500 for, or 5,000 rather, excuse me, $5,000 for a tube of gold eagles. And now they're, 60,000. It's beginning to add up very quickly. So yeah, what it would do is it would more or less blow up all the local coin shops, at least in their ability to buy or sell gold, silver, maybe, but it would just, the big 5 or 6 online companies, Miles Franklin, APMEX, Money Metals, SDJ. We'd all be able to continue to do things, but there would be a lot of smaller companies that would find it too challenging to provide customer service in a timely fashion when you're short on cash and overextended in your line of credit is not an easy thing to do.
As gold's price rebounded from a significant low, it reaffirmed its status as a critical asset during economic uncertainty. Initially marked by reduced demand and low prices, gold experienced a long-term surge driven by global financial crises and instability. Its role as a store of value and safe haven investment has become even more essential, with prices continuing to respond to economic conditions and investor sentiment globally. What do you think the future holds for gold as a safe haven asset? Let us know in the comments below. If you found this content valuable, give it a thumbs up and subscribe for more. Thanks for watching.